Right now, at this exact second, there's $1.65 trillion with a T in shadow debt, just hiding entirely off the books of the biggest, most profitable tech companies in the world.
Yeah, and I mean, that number isn't some wild conspiracy theory. It's actually
Yeah.
the calculated reality of how this current artificial intelligence boom is, well, how it's actually being funded behind closed doors.
Right, exactly. So, welcome to the deep dive. Today, we are looking at the frankly terrifying math behind the AI infrastructure race.
Absolute terrifying.
Because, I mean, if you're listening to this, you're likely one of the rational, hardworking citizens of the world who has been watching this all play out, and your gut is just telling you that something is deeply, deeply wrong here.
Oh, totally. You see these trillion-dollar valuations.
Right? And you read the headlines about these massive, incredibly power-hungry AI data centers.
Yeah, and you hear all this endless utopian hype from tech executives, right? And you just think, wait, this doesn't add up. Where's all this actual money coming from?
Exactly. It's a very valid instinct to have.
It really is.
Yeah.
Because, we like to think of technological breakthroughs as organic, right? Like you invent something useful, people buy it, the revenue comes in, and then the company grows.
That's the normal way. Yeah.
Right. But what we are seeing right now in the AI sector is this financial landscape that honestly just defies basic mathematical gravity.
It really does. I mean, the numbers are astronomically large, but the underlying foundation is just incredibly opaque. You can't see what's holding it up.
Exactly. It's built on sand.
So our mission today is to dig into that opacity. We want to validate and, frankly, elucidate this outrage that is brewing among everyday people toward the way these tech giants are operating right now.
Yeah, because there is this specific outcry, a battle cry really, that companies, specifically legacy giants like Oracle, are basically risking the broader economy on this unscrupulous gamble.
Right, and the public is shouting that these companies are, not too big to fail.
Which, by the way, is a sentiment backed by some very sobering, very hard data that is just now starting to breach the surface of the mainstream financial press.
Okay, so we have a massive stack of source material to get through today, and we aren't just looking at opinion pieces here.
No, not at all. We're looking at hard numbers.
Exactly. We're breaking down a highly rigorous working paper from the BIS, that's the Bank for International
The
Settlements.
central bank for central banks, yeah.
Right. And we've got deep financial analyses from IDC and S&P Global Ratings. Plus, we're pulling some intense investigative reporting from the Times of India and Tech Radar.
We also have that really brilliant breakdown from the YouTube channel, Cloud Computing Insider.
Oh, yeah, that one is great. And we are even diving into the raw, unfiltered community sentiment from Reddit just to see what the actual engineers and customers on the ground are saying.
And it's a diverse set of sources, right?
Mm.
But what's so fascinating is that whether you were looking at central bank mathematics or, a frustrated database administrator on Reddit, all the evidence is pointing toward the exact same macroeconomic vulnerability.
Which is what exactly.
That we are looking at a system that is historically over-leveraged and just incredibly highly intertwined.
Okay, let's unpack this. I want to start with a term that kept coming up in that IDC report because it seems to be the engine of this entire thing. The phrase is circular financing.
Oh, yeah. Circular financing.
Walk me through what that actually means, in the context of these massive tech giants.
So to really understand why the current AI market looks the way it does, you have to look at how revenue is being reported, right?
Okay.
According to the IDC report, circular financing occurs when the exact same pool of capital, the exact same money functions simultaneously as a vendor payment and an equity stake.
Wait, meaning the money is basically doing double duty?
In a sense, yeah, exactly.
Yeah.
Let's say company A invests $1 billion into company B.
Okay, got it.
Company B then takes that exact same $1 billion and uses it to buy servers and cloud infrastructure back from company A.
Oh, wow. So they just hand it right back.
Right. And when earnings season comes around, Company A gets to go on TV and report a massive surge in cloud revenue to Wall Street.
But if you look under the hood, Company A essentially just funded its own customers' revenue.
Precisely. The money just moved in a closed loop.
So it artificially inflates their reported revenue, making the stock look incredible without any actual organic demand coming from the outside world.
Exactly. It creates this complete illusion of limitless demand.
I mean, that sounds illegal, or at least like a really shady, quirky accounting loophole.
It's definitely a loophole, yeah.
Is this essentially like me giving you $1,000 to buy my old car, and then me running down to the bank to claim my new car dealership just generated $1,000 in organic sales?
Honestly, that analogy works perfectly on a mechanical level.
But it's just one car.
Right.
Yeah.
If you do that with one car, it's a quirky trick. But when you scale that up to tens of billions of dollars, you create a systemic financial distortion.
Which brings us to the Times of India data, I think.
Yes, because that data lays out the sheer scale of this regarding OpenAI and its partners.
I read those numbers, and they are just staggering. The Times of India reports that OpenAI's partners, and they specifically name Oracle, SoftBank, and CoreWeave, have amassed a collective $100 billion in debt linked to the AI firm.
100 billion.
With the B.
100 billion in borrowing just to support OpenAI. Meanwhile, OpenAI itself is carrying like very little debt on its own books, right?
Yeah, the financial disparity there is the absolute key to this whole thing. The reporting notes OpenAI has a $4 billion credit facility that they haven't even fully tapped into yet.
So they're keeping their own balance sheet basically pristine.
Completely pristine. But their partners are taking on massive high-interest debt to build the physical data centers that OpenAI desperately needs just to train its models.
But here's the jaw dropper, and this is where I really need you to explain the logic to me because it makes no sense.
Sure, lay it on me. OpenAI has 1.4 trillion with a T in procurement commitments over the next 8 years. They are contractually promising to buy $1.4 trillion worth of compute power.
Yep.
But their expected annualized revenue for this year is only around $20 billion. How does a company with $20 billion in revenue secure $1.4 trillion in infrastructure?
Well, by weaponizing FOMO, basically, the fear of missing out.
FOMO, for trillions of dollars.
Yeah. The strategy, which was quite literally stated by a senior OpenAI executive to the Financial Times, is all about leveraging other people's balance sheets.
Leveraging other people's money.
Exactly. They are using the hype of artificial general intelligence, this promise that whoever wins this race is going to control the entire future of the global economy, to convince their partners to shoulder the crushing financial burden of actually building the infrastructure today.
But it's not just a simple two-way street, right? When I was reading that IDC breakdown, it's not just one company funding another. It's this massive, incestuous vortex of capital.
It really is a vortex.
Can you trace the money for me? Like, let's start with NVIDIA, since they make the actual chip.
Yeah, let's trace it because it is an absolute marvel of financial engineering.
Yeah.
So it starts with NVIDIA, the primary manufacturer of the GPUs powering this whole boom.
Right.
NVIDIA commits $30 billion as part of OpenAI's broader financing. So NVIDIA is a major equity investor in OpenAI.
Okay.
Simultaneously, NVIDIA is OpenAI's primary hardware supplier.
Okay, stop there. So NVIDIA gives OpenAI billions, and OpenAI turns around and uses that exact money to buy chips from NVIDIA.
Yes, but wait, it gets even more complex.
Of course it does.
NVIDIA also holds equity in a specialized cloud provider called CoreWeave.
Okay, CoreWeave.
And CoreWeave then supplies infrastructure to Oracle.
Okay.
Oracle, in turn, turns around and signs a massive, multi-year $300 billion compute deal with OpenAI.
It just makes my head spin. Seriously.
Oh, I know, it's a lot.
So NVIDIA funds OpenAI, and NVIDIA funds CoreWeave. CoreWeave supplies Oracle. Oracle signs a $300 billion deal with OpenAI. OpenAI uses the money NVIDIA gave them to pay Oracle. Oracle pays CoreWeave. CoreWeave buys more chips from NVIDIA.
It is a totally self-reinforcing loop of astronomical proportions.
But wait, if they're all just passing the exact same giant bag of money around in a circle, how are their valuations all skyrocketing?
Well, because public markets generally value companies based on top-line revenue growth and, future bookings.
Oh, I see.
Yeah, so when you look at NVIDIA's revenue growing from $27 billion to over $216 billion in 3 years, or Oracle showing massive future bookings, it looks incredibly robust on a quarterly earnings call.
Because the line is going up.
Right, but it is mathematically impossible to separate the genuine market demand like actual companies buying AI to solve real-world problems from this self-reinforcing investment activity.
The money is just spinning in a centrifuge.
Exactly. It's inflating the valuations of every single company in the circle, but it does not represent new external value being created.
And this, right here, is exactly why the hardworking citizen tuning into this deep dive needs to care.
Absolutely.
Because why should you care about a bunch of Silicon Valley billionaires trading money in a circle? Well, because this financial engineering is what is inflating the broader stock market right now.
Right.
This loop is single-handedly propping up the S&P 500. This means that if you have a pension, a 401k retirement account, or literally just a basic index fund, you are unwittingly exposed to this synthetic demand.
That is the core danger here. The stock market has completely tethered itself to this loop.
And if the loop breaks,
If that loop breaks, meaning if actual outside enterprise revenue doesn't eventually materialize to replace all this circular investment money, the valuations of these tech giants will collapse.
and who gets hurt? Not the executives.
No, it's not the venture capitalists who will be left holding the bag. I mean, they take their management fees regardless.
Right.
It's the everyday investors whose retirement funds are heavily weighted toward these massive tech stocks. They're the ones who lose.
But, okay, if they are taking on hundreds of billions in debt to keep this loop going, how are they not being punished by the bond markets right now? Like, how are they hiding the debt required to build all these data centers?
Well, that brings us to the $1.65 trillion question.
Oh, boy.
We're looking at absolute echoes of Enron in the way this debt is being structured.
Enron. That is not a name you want to hear in finance.
No, it's not. The Tech Radar report pulls from a really deep investigation by Nikki Asia, and the headline number is just chilling.
What is it?
They estimate that 5 giants, Alphabet, Microsoft, Amazon, Meta, and Oracle, are currently hiding $1.65 trillion in debt outside their official financial statements.
Just to contextualize that for the listener, 1.65 trillion is more than the official on-the-books debt those 5 companies disclosed last quarter, which is around 1.35 trillion.
Right.
They literally have more debt hidden in the shadows than they do visible on their balance sheets. Meta alone reportedly holds roughly $420 billion of this off-balance sheet obligation.
It's staggering.
How is that even legal? Like, how does Mark Zuckerberg just hide nearly $500 billion in debt?
Through the aggressive use of SPVs, or special purpose vehicles.
SPVs. Okay.
This is a very specific, very clever accounting mechanism. Basically, a parent company, let's say Meta or Microsoft, creates a legally separate subsidiary company.
Like a shell company.
Sort of, yeah.
Yeah.
This subsidiary exists for a single specific purpose, to take out massive loans and build AI data centers.
Okay, I follow.
Because the SPV is technically a separate legal entity with its own governance, the debt it takes on does not have to be consolidated or reported on the main balance sheet of the parent company.
I have to push back here because this is where my skepticism really kicks in.
Go for it.
I remember Enron. Enron was an energy trading company that used SPVs to hide massive toxic losses until the whole thing imploded overnight.
Right, exactly.
But Microsoft and Alphabet aren't Enron. I mean, they have literal mountains of cash on hand. Alphabet prints money every second through search ads. Why would a trillion-dollar fortress like Microsoft need to use an Enron-style accounting trick?
It's a great question. It really is. And it fundamentally comes down to capital efficiency and risk isolation.
Okay, explain that.
So, even with massive cash reserves, building out $3 to $4 trillion in infrastructure globally over the next few years, that would deplete even their cash.
True.
And it would severely drag down their profit margins and their return on invested capital. Wall Street hates it when high-flying tech companies suddenly become boring, capital-intensive utility companies.
Right, because utility companies don't get 50x earnings multiples.
Exactly. So by using SPVs, Microsoft and Amazon can get the data centers built, they can keep their core profit margins looking totally pristine for shareholders, and most importantly, they isolate the downside risk.
Here's where it gets really interesting. Isolate the risk. Meaning, if the AI boom goes bust, the SPV goes bankrupt, but the parent company's stock is legally shielded.
That is the exact goal. And the accounting consultant quoted in the Bloomberg piece, referenced by Tech Radar, a guy named Tom Selling, he points this out explicitly.
What does he say?
He says this specific accounting treatment is currently, quote, in fashion again.
In fashion, like flared jeans.
Right. It always comes into fashion during massive capital booms. But the huge risk here is that if the underlying premise of the boom is flawed, the whole thing comes down anyway, because those SPVs are still deeply intertwined with the parent company's actual daily operations.
So they aren't as shielded as they think.
Exactly. We are looking at the potential for what some are calling a subprime data center crisis.
A subprime data center crisis. Wow, that is a very deliberate phrasing.
Very deliberate.
Because that immediately echoes the 2008 subprime mortgage debacle.
It's highly deliberate. I mean, think back to 2008. The toxic assets were bad mortgages granted to people who couldn't pay them, bundled together and hidden within complex financial instruments that the ratings agencies just rubber stamp.
And to
Today, the potentially toxic assets are multi-billion-dollar AI data centers, funded by hidden SPV debt, relying on a circular revenue stream that hasn't actually proven it has real organic end-user demand.
But hang on, because reading through that tech radar piece, there was a specific phrase that genuinely made my stomach drop.
Which one?
Non-recourse.
Ah, yeah.
Walk me through how that works in this specific setup. Because, I mean, if I go to a bank for a mortgage, they look at my income, my assets, my credit score, everything. If I don't pay, they take the house and they can sue me for the difference.
Right, but non-recourse debt is the absolute linchpin of this entire shadow structure.
How so?
When these SPVs take out billions in loans to build a data center, the loans are often structured as non-recourse to the parent company or the developer.
Meaning what exactly?
That means if the SPV defaults, like if OpenAI can't pay the rent on the data center and the SPV goes bankrupt, the lender can only seize the collateral specified in the loan.
Which is just the data center itself.
Exactly. The banks cannot go after Microsoft's or Oracle's other assets. They can't touch their cash reserves.
Okay, I have to ask. Why on earth would a bank agree to a non-recourse loan for a highly speculative, single-use AI data center? Like, if they absorb all the risk, what are the banks thinking? Did they learn literally nothing from 2008?
It seems they didn't. The banking sector is suffering from the exact same FOMO as the tech sector right now.
Really? The banks are just as caught up in the hype.
Completely. These data center deals come with incredibly attractive high interest rates in the short term. The banks look at the, say, 15-year lease agreements signed by companies like OpenAI or Anthropic, and they treat those future lease payments as guaranteed income.
But it's a startup.
Right. But they see the backing of massive tech titans, even if it's purely informal or legally shielded by the SPV, and they just assume the risk is zero.
So once again, we have a system where the risk is being aggressively socialized across the banking system and the broader economy, while the profits during the boom phase are entirely privatized by the tech executives, the hardware suppliers, and the early investors.
It's the classic moral hazard.
If AI wins, they get rich. If it fails, the financial system takes the blow.
Exactly. When you combine non-recourse debt, circular financing, and off-balance sheet SPVs, you create a macroeconomic shell game of unprecedented scale.
Well, let's zoom in on the prime offender in the eyes of the public outcry. Because if you spend any time at all looking at the sentiment of the rational citizens out there on the internet, their anger is highly, highly concentrated.
It really is.
Let's talk about Oracle, because the cry of the masses right now is that Oracle is not too big to fail.
Right.
And looking at the S&P Global ratings report we have, the elite ratings agencies seem to actually agree with the angry people on Reddit for once.
They absolutely do. S&P Global Ratings recently made a really major move.
What did they do?
They downgraded Oracle's long-term issuer credit rating to BBB from BBB. They also lowered their short-term rating to A3.
Okay, for the listener who doesn't spend their day looking at corporate bond ratings, translate that for us. How bad is BBB?
BBB is the absolute lowest rung of investment-grade debt.
The lowest rung.
Yes, it is exactly one notch above speculative grade.
Speculative grade. So literally one notch above what the financial world calls junk status.
Yes, junk bond territory.
Wow.
This is not where a legacy blue-chip tech behemoth wants to be at all.
What happens if they drop one more notch?
If Oracle drops one more notch into junk status, a massive pool of institutional investors, like certain pension funds and mutual funds, are legally required by their own internal charters to sell Oracle's debt.
Because they aren't allowed to hold junk bonds.
Exactly. And that would massively increase Oracle's borrowing costs overnight.
And what was S&P's rationale for putting a giant like Oracle on the literal cliff edge of junk status?
Their rationale is incredibly telling, and it validates everything we just discussed about this bubble. They explicitly state that Oracle's rapidly expanding AI infrastructure business is precisely what is increasing its overall credit risk.
Wait, so the AI business is hurting their credit, not helping it?
Right. S&P basically admitted that they previously completely underestimated the sheer scale of the investments required for Oracle to play in this game.
I was looking at the numbers in that S&P report, and they are wild. Oracle previously guided their capital expenditure, their CapEx, the money they spend on physical assets like data centers, to be around $60 billion.
Which is already a huge number.
Huge.
Mm.
But now, for fiscal 2027, that guidance has skyrocketed to between $90 and $95 billion.
Yeah.
That is a $35 billion miss in their own internal estimates.
Think about the cash flow implications of that, right?
Yeah.
A $35 billion unexpected increase in physical cost.
Why is it jumping so high?
Well, S&P attributes that to rising component costs,
Yep.
because NVIDIA chips certainly aren't getting cheaper, and the massive long-term data center leases required.
Okay, but here's the most dangerous part of the S&P analysis, in my opinion. This is the part that should make any Oracle shareholder sweat.
Let's hear it.
It involves something called RPOs.
Ah, yes. RPOs, remaining performance obligations.
Right. RPOs are basically money that customers have contractually promised to pay Oracle in the future, right?
Correct. It's the backlog,
And Oracle currently has $638 billion in RPOs.
which sounds phenomenal on a PowerPoint slide deck.
Almost 2/3 of $1 trillion in guaranteed future revenue. If I'm an Oracle shareholder, I'm thrilled. I'm popping champagne.
You're thrilled right up until you read the fine print in the S&P report.
Right. What's the catch?
S&P estimates that roughly half of that entire $638 billion backlog is owed by a single customer.
Let me guess.
Go ahead.
OpenAI.
OpenAI.
Oh my God.
Yeah.
So OpenAI, a single startup that is burning cash at an unprecedented rate, a company that we just established is surviving on circular financing from its partners, is responsible for half of Oracle's entire future revenue pipeline.
It is a staggering single point of failure. S&P explicitly calls OpenAI a key credit risk for Oracle.
I mean, I would hope so.
Their logic is brutally simple. If OpenAI cannot meet its contractual obligations, if they fail to raise another massive round of external financing, Oracle is left holding massive data center leases that they cannot exit.
And half their future revenue just vanishes into thin air.
Poof, gone.
This connects directly to the YouTube source we pulled from Cloud Computing Insider. The host there was analyzing Oracle's recent moves, and he points out that Oracle is borrowing $56 billion specifically for AI data center project financing.
Which is a massive, highly leveraged bet.
As the analyst said, it's a go big or go broke trade.
And you have to understand the physical reality of infrastructure here, right?
Right.
Because in the software world, if a product fails, you just stop writing code, you maybe fire the engineers, and you move on.
Low overhead.
Right. But in the physical infrastructure world, the debt clock starts ticking on day one.
Yep.
When you borrow $56 billion to pour thousands of tons of concrete, install these massive liquid cooling systems, and sign 15-year land and power leases, you have to service that debt immediately.
The banks don't care if the servers are empty.
Exactly. You have to pay the interest every single month, regardless of whether a single customer ever actually rents server space in that building.
Which brings me to the public sentiment, because this is where it really starts to boil over for the everyday person. We spent some time diving into the Reddit community, specifically the Roracle subreddit, just to gauge how the actual tech community feels about Oracle's current predicament.
And what did you find?
The validation of the public's outrage is everywhere. People are practically cheering for Oracle to fail.
I saw that. It's intense.
Why is there so much animosity toward this specific company?
Well, the Reddit consensus is highly focused on Oracle's historical business practices, specifically their license management services, or LMS.
Yeah, users constantly compare Oracle to the mafia.
Yes, they do.
Explain to me how an LMS audit works, because the vitriol from these IT workers is just intense.
Okay, so for decades, Oracle's core business model has been to give enterprise customers a seemingly cheap entry price for their database software.
Get them in the door.
Right. A hospital or a huge bank starts using Oracle. They build their entire IT infrastructure around it. It becomes the beating heart of their data.
Okay.
Then, years later, Oracle unleashes an LMS audit. They send in these incredibly aggressive auditors to scour the customer servers, looking for any minute technical violation of their wildly complex licensing agreements.
Like, oh, you installed it on a server with 2 processors instead of 1.
Exactly that kind of thing.
Yeah.
And when they find a violation,
What happened?
they demand exorbitant, multi-million-dollar true-up fees.
Yeah.
And because the customer's entire business is running on that database, it is technologically and financially devastating to try and migrate away.
They're trapped.
They're completely trapped. They basically have to pay the ransom.
Wow. One Reddit user literally wrote, "It's like getting in bed with the mafia, minus the perks."
That sums it up perfectly.
So they lock customers into expensive contracts, making it impossible to leave. But here's the supreme irony that the hardworking citizen can really appreciate. A company famous for aggressively trapping its customers in complex, unbreakable dependency is now itself potentially trapped by a massive, unbreakable debt load and a single, highly volatile giant customer in OpenAI.
It is a profound historical irony. I mean, for decades, Oracle's leverage was that they had the ultimate captive audience.
Right.
But now, in their absolute desperation to catch up to Amazon and Microsoft in the AI cloud race, they have willingly become the captive.
They became the hostage.
Exactly.
Which reiterates the battle cry of the masses. Oracle is not invincible. They're not too big to fail. As that YouTube analyst noted, if this AI bet fails, Oracle does not get a mulligan on the power bills.
No, they don't.
They can't just negotiate away the hardware depreciation or the interest payments to the banks like they do with their own customers. The bill comes due.
And that brings us to the core macroeconomic question that overrides all of this. Is this boom mathematically destined to bust?
Oof.
And for that, we have to look at the central bank modeling.
Let's do it. We're looking at BIS Working Paper No. 1367 titled The AI Investment Race.
Right.
And just for context, the Bank for International Settlements, as we said, is the central bank for central banks. They don't write clickbait.
No, they definitely do not.
When they publish a warning, the global financial world listens. And this paper is a rigorous mathematical dissection of why an AI infrastructure bust might not just be possible, but mathematically certain under the current conditions.
The brilliance of the BIS paper is how it models the current AI race. They call it a dynamic contest.
A dynamic contest. What does that mean?
This is a crucial economic concept. In a normal market, if 10 companies decide to build a new type of smartphone, they might end up sharing the market proportionally based on quality, price, or marketing, right?
Yeah, you have Apple, Samsung, Google all sharing the pie.
Exactly. There's room for several winners. But the AI infrastructure race is what economists call a winner-take-most environment.
Meaning there is absolutely no prize for second place.
Right. The major coalitions, the Microsoft OpenAI coalition, the Oracle OpenAI alliance, the Amazon Anthropic partnership, Google with DeepMind, they all fundamentally believe that whoever achieves artificial general intelligence first, or whoever builds the absolute most dominant foundation model, will capture nearly all the economic value of the entire sector.
So the stakes are literally everything.
Everything. Because the reward for being first is perceived to be near infinite. The rational incentive for each individual player is to massively overcommit resources to ensure they win.
So what does this all mean? It sounds like a high-stakes game of poker where everyone at the table is betting with borrowed money, but the prize pot they're fighting over doesn't actually exist yet.
That is a highly accurate way to frame the psychology, yeah.
Yeah.
But the BIS model calculates the exact mathematical outcome of this dynamic contest.
What's the math say?
Because every single coalition is aggressively overinvesting to edge out the others, the sector as a whole becomes prone to massive structural overinvestment relative to what is socially or economically optimal.
Okay, give me the numbers.
The BIS model points to an overinvestment rate of 1.5 times the efficient level in a baseline scenario.
Wait, 1.5 times. So they're building 50% more infrastructure than the world actually needs.
Yes, and that is just the baseline. It actually gets much worse.
How does it get worse than 50% overcapacity?
Well, the paper models that where demand is less elastic, meaning where customers are locked into an ecosystem, or where the strategic advantage of being first is perceived as an existential necessity, which is exactly what's happening now, that overinvestment ratio rises to 3 times the efficient level.
3 times?
3 times.
You're telling me they are potentially building 3 times more data centers, buying 3 times more GPUs, and securing 3 times more power grid capacity than the actual end-user market could ever possibly consume.
That is exactly what the mathematics of a dynamic contest dictate. And the BIS places this in historical context, which is really fascinating.
Yeah, they do some historical comparisons, right?
They look back at the history of technological booms. They compare the current trajectory to the canal mania of the 1790s, the railway mania of the 1840s, the roaring 20s stock boom, and the dot-com bubble of the late 90s.
Classic bubbles.
Right. And the AI boom, just 3 years past its trough, is already outgrowing every single one of those historical episodes in terms of capital intensity.
I have to push back here, though, because I hear this specific comparison a lot. People always say, oh, it's just like the dot-com crash.
Sure, it's a common refrain.
But in the late 90s, telecom companies spent billions laying dark fiber optic cables all over the world. The companies went bankrupt, sure, but that fiber stayed in the ground, and it ended up being incredibly useful.
It did, yes.
It literally became the backbone of the modern internet we use today. So even if they are overbuilding AI data centers by 3 times, isn't that ultimately good for society? Won't we just have super cheap compute power later?
That is the standard Silicon Valley defense right now.
Is it wrong?
Yes, and the BIS paper explains exactly why AI infrastructure is fundamentally different from dark fiber. It comes down to the nature of the capital being deployed.
Okay, unpack that.
A fiber optic cable is a general purpose conduit, right? You push anything through it. Email, streaming video, whatever. But the capital being bought today, the GPUs, the custom-built server racks, the specialized liquid cooling systems required to keep these AI chips from literally melting, it is highly, highly specialized.
So it's not like a regular office building that you can just rent out to an accounting firm if the tech company goes bankrupt.
Exactly. A specialized AI data center is optimized for one very specific task, training massive neural networks. If the bubble bursts and the revenue isn't there, every hyperscaler and AI lab will be forced to fire sale their equipment at the exact same time to service their massive debts.
But if everyone is selling at once.
Nobody's buying.
Right.
The resale value plummets.
Right.
And because the hardware is so specialized, it can't easily be repurposed for generic cloud computing. You can't just run standard web servers on a rack designed for H100 GPUs without massive retrofitting.
So what's it worth then?
The BIS model calibrates the scrap recovery rate at just 1/5 of the initial cost.
Wait, 1/5? 20 cents on the dollar.
20 cents on the dollar.
That's insane.
If a company like Oracle defaults on $1 billion worth of AI servers, the bank that issued the non-recourse loan can only recover $200 million. That 80% destruction of capital cascades through the entire financial network.
And remember that circular financing loop we discussed earlier, where everyone owns a piece of everyone else.
Right. NVIDIA owns CoreWeave, who supplies Oracle, who funds OpenAI.
So if one falls.
Because of that circular equity, a shock to one firm propagates immediately. If OpenAI defaults on Oracle, Oracle's Stark tanks, which hits CoreWeave, which hits NVIDIA.
It's a domino effect.
It becomes completely systemic, potentially taking down the banks that issue the shadow debt and crippling the broader economy.
The BIS paper calls this an endogenously generated boom-bust cycle, meaning the boom creates the very conditions that guarantee its own destruction.
Precisely. The more capacity the sector builds, the more trillions they pour into these massive facilities, the higher the subsequent productivity bar they must clear to sustain those valuations.
Because you have to justify the spend.
Right. If you borrow $50 billion, you only need to invent a technology that generates $55 billion to look like a genius.
Makes sense.
But if you borrow $3 to $4 trillion, you need to invent a technology that fundamentally alters global GDP just to break even.
And what does the BIS conclude about their ability to actually clear that bar?
This is the scariest part of the paper. At a projected $3 to $4 trillion in overall capital expenditure, the BIS model calculates that the net economic surplus is expected to turn negative in expectation. Negative. The sheer cost of building and powering the infrastructure will exceed the total economic value it can generate.
That is a terrifying mathematical certainty. If the infrastructure is being overbuilt by a factor of 3, and the debt load guarantees a systemic fire sale with an 80% loss upon any demand shock, the obvious question is, where is the actual demand supposed to come from to prevent this?
Right.
Where are the everyday customers who are going to pay the trillions of dollars needed to service this debt?
Well, that is the trillion-dollar question, which brings us to the final reality check. We have to look away from the infrastructure layer, all the chips and concrete, and look at the application layer.
Right. So we turn to the report from IDC, authored by Eric Newmark.
Excellent report.
His central thesis cuts right through the noise of the hardware hype. He argues that the enterprise application layer, meaning the actual software being sold to normal businesses, is the real signal of the AI market.
And why is that?
Precisely because it does not carry a circularity problem.
Exactly. Think about a major non-tech corporation. Let's say, I don't know, a global shipping company or a massive retail chain like Walmart.
Okay.
When they buy an AI-enabled supply chain optimization tool, they are using real external budget dollars.
Right. They aren't taking an equity stake in the software vendor.
Exactly. They aren't funding a startup just to buy their own chips. It's a clean, arm's-length transaction.
Real money changing hands.
Real money. Therefore, the application layer is the ultimate proof point on which this entire multi-trillion-dollar infrastructure narrative depends. If real businesses aren't buying AI software, the whole thing collapses.
But the reality on the ground is grim, isn't it? The infrastructure layer is currently eating trillions of dollars, but according to IDC's Future Enterprise Resiliency and Spending Data, or FERS,
The FERS data, yeah.
organizations are reporting very few measurable financial results from their AI projects.
The data is highly revealing. It shows that while AI tools might make an individual coder or, an individual copywriter slightly more productive on a Tuesday afternoon,
Right. They can write an email faster or debug a Python script quicker.
those micro efficiencies are not translating into macro-level organizational financial outcomes.
Right. Just because your marketing team wrote a blog post in 10 minutes instead of an hour doesn't mean the company suddenly doubled its overall profit margins.
Exactly. These tools aren't moving the needle on corporate profit margins in a way that actually justifies the massive software premiums vendors like Microsoft are trying to charge for tools like Copilot.
I mean, it's expensive software.
It is. And the YouTube analyst from Cloud Computing Insider touched on this perfectly.
What did he say?
He said enterprises move slowly. They just do. They don't operate on the timeline of Silicon Valley hype cycles. Most Fortune 500 companies have incredibly messy internal data.
Oh, data silos everywhere.
He estimated they face a 3 to 5 year journey just to clean up their data hygiene before AI can even be effectively deployed on their proprietary information.
That impedance mismatch is the critical flaw in the hyperscalers timeline, isn't it?
It absolutely is.
Oracle, Microsoft, Amazon, they're building data centers today under the assumption that corporate America will adopt AI at a pace of a 10.
Right.
But the reality, due to data security concerns, regulatory compliance, and simple corporate inertia, is that adoption is moving at a 3 or 4.
And the IDC report notes, this monetization gap has historical precedent. In the late 90s, during the dot-com boom, infrastructure companies like Cisco captured the overwhelming share of market value initially.
Cisco actually became the most valuable company on Earth for a brief moment in 2000, right? Simply because they supplied the routers and switches.
Exactly. And similarly, in the early days of the cloud computing transition, AWS spent years building massive infrastructure, while the software as a service application layer took much longer to prove its business viability to hesitant corporations.
But here's the difference this time, right?
What's that?
If these new enterprise AI applications don't deliver hard, auditable business outcomes like massive cost reduction or measurable workflow transformation, the CFOs of these normal companies are simply not going to renew their AI software contracts next year.
No, they won't. The novelty will wear off.
That is the cliff edge.
If enterprise software vendors cannot prove that their AI features justify the cost, the buyers will churn.
And when they churn.
That demand signal dies. When the software vendors lose revenue, they immediately scale back their compute usage to save money.
Which means less usage on the servers.
Exactly. When compute usage drops, OpenAI and Anthropic stop buying capacity from Oracle and Microsoft.
And when Oracle and Microsoft have massive excess capacity just sitting idle, what do?
Well, they have to slash prices to try and fill the servers, just to make their minimum debt interest payments to the banks.
Which triggers the exact death spiral the YouTube analyst warned about.
Yep, as he put it, once you start discounting cloud, you don't magically re-extend margins later.
Right.
They will be operating at a massive loss, hemorrhaging cash, just to keep the cooling systems running in these massive facilities.
Are we going to see these multi-billion-dollar data centers turned into empty skating rinks? That was the vivid image the analysts left us with, and I can't get it out of my head.
It's a haunting image.
Just colossal monuments of concrete and steel sitting in the middle of nowhere, consuming massive amounts of grid power, completely devoid of actual economic utility.
If the overinvestment reaches the 3x multiple modeled by the BIS, and the enterprise adoption stalls the application layer as the IDC data warns, then yes.
Wow.
Empty data centers or data centers sold for scrap value are a highly probable mathematical outcome.
This brings us back to you, our listener. We told you at the very beginning of this deep dive that your skepticism was entirely justified, and we have spent this time validating exactly why.
Your gut was right.
The outrage you feel when you see tech executives cheerleading this boom on television while completely ignoring the fundamental economic realities is the correct response.
This isn't just a story of organic technological progress. What the data shows is a highly leveraged, off-balance sheet house of cards fueled by the diabolical practice of circular financing.
Companies like Oracle are risking their very foundations to chase a hype cycle. And in doing so, they are trapping themselves in the exact kind of high-stakes, low-recourse dependency they use to weaponize against their own customers.
The numbers don't lie, and frankly, they aren't hiding. $100 billion in partner debt against $20 billion in revenue.
$1.65 trillion hidden in special purpose vehicles.
A projected $3 to $4 trillion in capex that the central banks predict will yield a negative economic surplus.
It is a financial scheme of epic proportions, and it is built on a foundation of sand.
And, as always, the risk has been quietly socialized to the broader economy and the banking sector, while the potential rewards remain aggressively privatized for the few at the top of the loop.
The masses of good-natured, rational, hard-working citizens are right to cry out. Oracle is not too big to fail. None of them are. The math applies to everyone eventually.
It really does.
So as we wrap up this deep dive, we want to leave you with a final lingering thought to mull over. We've spent all this time talking about the human greed, the FOMO, and the corporate financial engineering behind these massive AI systems.
But let's think about the systems themselves for a second.
Yeah.
It raises a fascinating philosophical paradox.
What's it?
Well, if these advanced AI models, the very models this entire house of cards is being built to support, are truly being trained on the entirety of human history, global economics, and financial knowledge.
Right.
And if they eventually achieve the true, cold, unvarnished reasoning capabilities their creators promise.
Is it possible that their very first logical deduction, upon analyzing their own massive, highly leveraged, circularly financed foundations, will be to advise their creators to immediately file for bankruptcy?
Honestly, it would certainly be the most rational conclusion.